So we're picking up here where we left off in class. I think I covered this particular question in my 9 o'clock class, but not in my 8 o'clock class, so I'm just going to do it real quickly again. After posting the entries to close all revenue and expense accounts, what does a credit balance in the income summary account say about net income or loss? What about a debit balance? Well, we talked about this already. Basically, anytime the income summary account, after you've already closed revenues and expenses to it, if it has a credit balance, that means credit balance means that revenues were greater than expenses because revenues carry a credit balance. And debit balance means that expenses were greater than revenues. Okay? Based on that information, you should be able to say, okay, if revenues are greater than expenses, does that mean a net income or a net loss for the period? Well, obviously, if revenues are more, that's a net income. Okay? So that should be pretty self-explanatory. Okay, this is going to look familiar because it's similar to one we already did, but now instead of talking about doing the reversing entry, remember earlier we did the January 1st entry where we reversed what we did on December 31st. Now it's January 3rd and we are paying the $35,000 here for these salaries. Okay, so now that we did the December 31st entry showing this amount and then the next day we reversed that, it's as if that never happened, right? That's what the reversal does. So now we kind of ignore this 22.5 and we just say, okay, on January 3rd, we're going to pay employees $35,000 for work that they've done. So we're going to recognize salaries expense, $35,000, and we're going to be paying them in cash, $35,000. So within that $35,000, we have contained all of this 22.5. Okay? So again, December 31st, we put it on the books. January 1st, we basically took it back off the books, although we still have that audit trail. And then when the 3rd rolls around, the effect of that 22.5 is contained within this $35,000 salary expense. Okay? So now, as of January 3rd, all of that is being put on there again. Okay? Next question. The R. Valens capital account has a credit balance of $28.5 before closing entries are made. If total revenues for the period are $185, total expenses $95.3, and withdrawals $19.1, what is the ending balance in the capital account after all closing entries are made? Okay, similar to the one we've already looked at. So, beginning balance. It's not going to make you calculate it this time. Credit balance, $28.5. Whoops. Okay. Then we have basically the effect of net income or net loss. Well, do we have net income or net loss? Revenues are greater than expenses, so we're going to have a net income here. How much? Equals $185,000 minus $95.3. 89.7 credit, net income. Okay, so add net income, credit 89.7, and I say add there because the capital account carries a credit balance. So when we put another credit in there, it's adding it. But using the terminology of add and subtract and also using the credit and debit terminology sometimes gets confusing. So I'm just going to say net income, credit 89.7. Then we've got owner's withdrawals 19.1. So that's actually going to be a debit. owner's withdrawal, debit 19.1. Okay, and now I just need to basically combine those. So if I have my owner's capital account over here, whoops. Okay, so I started with 28.5. Another credit of 89.7 from net income, and then a debit of 19.1. And I just need to know what the ending balance is there. So I would do this plus this minus this. Okay, so I have a $99,100 credit balance in the R balance capital account. I guess I should have named this like they do. Okay. And that's my answer. Okay, next question. After preparing and posting the closing entries for revenue and expense, the income summary account has a credit balance of $45,000. The entry to close the income summary account will be what? Okay, again, this is a temporary account. It currently has a credit balance. So to close it, we need a debit to income summary for that amount. And, sorry about that. My OCD won't let me leave that there. And then we have a credit to owner's capital for that amount. And again, this is the journal entry that moves the effect of net income into the owner's equity or owner's capital section. And that's what the entry looks like. Let's see. Okay, last question. Beginning of the year, a company's balance sheet reported the following balances. Total assets, $2,325,000. Total liabilities, $800,000. Owner's capital, $1,525,000. This plus this equals this, so we're good. During the year, the company reported revenues, $405,000, expenses, $226,000, owner's withdrawals, $188,000. Assuming there's no other changes to owner's capital, what is the balance in the owner's capital account at the end of the year? Okay, this is very similar to several we've already done, right? Okay. Okay, beginning balance. Owner's capital carries a credit balance. So when it tells us this is the total in owner's capital, it means there is a $1,525,000 credit balance in owner's capital. To that balance, we want to add the effects of net income or net loss and subtract any owner's withdrawals. Okay, so revenue minus expense, we'll do that right here. Net income equals 405,000 minus 226,000. Okay, we got net income 179,000. Since it's net income, that's a credit. So we will credit owner's capital for 179. Then we have a debit to owner's capital for 188 because that's the owner's withdrawal. And my balance obviously is going to be a credit balance because this side is greater than this side. So I'm going to total up this side, add that, plus, whoops. Okay, sorry. Try that again. Add this, plus this, minus this. Okay. And that's my ending balance. And that's it.